Welcome to The Explainer. Today, we're diving into Saifedean Ammous' The Bitcoin Standard, and we're going to explore its really big idea that the money we use doesn't just buy stuff, it actually shapes our entire world. And a new kind of digital money, well, that could change everything. So the book doesn't kick off with, complicated charts or economic theory. Nope. It starts with a question that's way more fundamental, one that makes you look at the cash in your wallet a little differently. What actually makes something good money in the first place? And the answer, according to the book, is surprisingly simple. It's not about what a government says is money. It's not about some intrinsic value. It all comes down to one thing: salability. Basically, the best money is just the thing that's the easiest to sell, the good that pretty much everyone will accept in a trade, no questions asked. But salability isn't just a single property. For something to really work as money, it has to be sellable in three key ways. It has to work across scales, divisible for a cup of coffee, but also useful for buying a house. It has to work across space, meaning it's easy to carry and use anywhere. And maybe most important of all, it has to work across time, meaning it actually holds on to its value. And this right here sets up the book's main event, the constant historical tug-of-war between hard money and easy money. Hard money, like gold, is, hard to make more of. That scarcity helps it store value. Easy money, on the other hand, like the currencies most governments issue today, can be printed pretty much endlessly, which almost always means the money you've saved becomes worth less and less over time.
So here's the thing. The book argues that choosing easy money isn't just some small policy decision. It's a choice that has massive and often really destructive consequences throughout history. Let's look at a couple of the stories the book tells to really drive this point home. First up is the incredible story of the Rye Stones from Yap Island. For centuries, these people used giant carved limestone wheels as money, and they worked as hard money precisely because they were so incredibly difficult to make and move. But then, an outsider showed up with modern boats and tools. He started cranking out new stones left and right, flooding the supply, and boom, the entire monetary system collapsed. Their hard money became easy money, and their wealth just vanished. And look, this isn't just something that happens on remote islands. The book draws a direct line from this same problem to the fall of the Roman Empire. Roman emperors kept reducing the amount of silver in their coins to pay for their wars and lavish spending. It was a short-term fix for sure, but over time it completely destroyed the currency and kicked off a vicious cycle of economic collapse. And this quote just nails the societal results of all this. When your money can't be trusted to hold its value, people stop thinking about the future. It becomes more profitable to gamble and speculate in the short term than to actually build or create things for the long term. The book says this is a classic symptom of a society in decay. This leads us straight to another huge idea in the book: time preference. It sounds complicated, but it's really not. It's just a way of measuring how much you value today over tomorrow. You know the famous marshmallow test? You can have one marshmallow right now, or if you wait, you can have two later. Well, your choice there reveals your time preference. Now here's the critical connection. The book's main argument is that the type of money we use directly influences our time preference. Easy money, the kind that's always losing value, pushes us to spend it now. That's high time preference. You see it in things like rising debt and a focus on instant gratification. Sound money, on the other hand, encourages us to save and invest for the future, which the book claims is the very foundation of civilization and progress. Okay, so if easy money is the problem, what's been the solution throughout history? Well, according to the Bitcoin Standard, for thousands of years, humanity's best answer was one particular shiny metal: gold. So why gold? Why not silver or seashells or anything else? The book argues it all comes down to a concept called the stock-to-flow ratio. All that means is you compare how much of something already exists in the world, that's the stock, to how much new stuff is produced each year, that's the flow. If that ratio is high, it's really hard to inflate the supply. It's hard money. And this chart really shows you why that's so important. Look at gold. The amount of gold already above ground is enormous compared to what's mined every year. So even if the price shot up and everyone started digging like crazy, they could barely make a dent in the total supply. It's stable. Now look at something like copper. It's the complete opposite, which is why it's a terrible way to store your wealth. The book points to the late 19th century, an era called La Belle Epoque as Exhibit A. Under the global gold standard, the world experienced this incredible explosion of peace, prosperity, and innovation. The argument is that this was no accident. It was the result of sound money encouraging people everywhere to think long-term, to save, and to invest in the future.
And that brings us to the final, and let's be honest, the most provocative part of the book. The argument that Bitcoin isn't just another tech stock, but is in fact the digital heir to gold, engineered to be the hardest money ever created. How does it achieve this? It's all in the code. Bitcoin's monetary policy isn't decided in a boardroom. It's written into the software itself. Roughly every 4 years, an event called the halving automatically cuts the new supply of Bitcoin in half. This makes its supply growth predictable, transparent, and always decreasing over time. And because it's enforced by a massive decentralized network, no government or corporation can ever change it. This whole process guarantees that there will never, ever be more than 21 million Bitcoin. It is the very first thing humans have ever created that has a provably finite, absolute scarcity. Unlike gold, we can't just invent new tech to find more of it somewhere. The limit is the limit, full stop. So the book's final take is that Bitcoin isn't trying to replace gold so much as upgrade it. The argument is that it takes all the properties that made gold the best money for millennia, its scarcity and durability, and perfects them for our digital world. It solves all of gold's physical problems. You can't send a gold bar across the internet, after all. At the end of the day, the Bitcoin Standard isn't really a book about how to get rich investing. It's much bigger than that. It leaves us with this huge, lingering question. If the money we use really does shape how we think about the future, and that in turn shapes our entire civilization, what kind of world could we build on a new foundation of truly sound money? And that's the powerful idea at the very heart of this book.